Joining us in studio to share his analysis on the day's markets performance is Jordan Toy from Legacy Family Wealth. Jordan, always a pleasure having you in studio with us. Now, what have you made of markets action? It's been quite confusing over the last few days. It doesn't seem like traders are actually reacting much to the possibility of tensions escalating. Yes, we've had that ceasefire announced by President Donald Trump, but we are still seeing strikes taking place between Israel and Iran. I was also looking at the VIX. Doesn't seem like they're pricing in any more or rather further escalating tensions. That index also coming in the red. What have you just been making of what we've been seeing playing out?
So I thought it was a very interesting example of how markets can continually surprise us. So, you know, the textbook view on that prior to the US strike was, okay, increasing tensions in the region. And we talked about this, right? We saw the oil price increase as tensions started ramping up in the region. But specifically when the US struck, you would expect oil to increase as well. It was largely contingent on Iran's response to that US strike. But what I think was a great example of markets keeping you on your toes is that that's the complete opposite of what happened. So markets and clearly market participants largely viewed this as, all right, this is kind of the peak sort of level of where we are, and that any retaliation from Iran is going to be limited. And that's exactly what we saw play out. I mean, I saw reporting from one of the US platforms that Iran actually notified the US ahead of that strike. So it's clearly a symbolic strike. So, you know, they showing that they're responding without actually intending to do much damage. So I think what we're seeing off the back of that, we saw the oil price drop. So markets largely viewing this as, all right, this is sort of the tensions that are in the past.
Okay.
You know, I think if there was any increase in or escalation again, we might see oil move, but probably not as much because the impact on the Strait of Hormuz has been limited. We've not seen any appetite from Iran to sort of restrict oil movement through that area. And also the fact that Iran arguably doesn't really want to restrict oil flow through that region because their financials are not in the greatest shape, and oil is a source of revenue for that country.
And we've seen that oil price back at levels it was last at around 2 weeks ago before the initial tensions escalated. So it's really been interesting to watch how markets are reacting to it all. We are still seeing that wait and see approach because, I mean, when you look now, trade remains choppy because we are still seeing the strikes taking place. So it just seems like investors don't want to make firm moves as yet until we actually see the ceasefire. We also have the trade deadline coming up in the next 2 weeks. So I guess uncertainty really remains the name of the game. How closely are you then watching what's playing out in the Netherlands, where we have the NATO summit? I noticed that defense stocks in Europe were up on the back of those nations affirming that they were going to increase defense spending.
So that's been a narrative for quite some time now, with the US sort of putting quite a lot of pressure on their fellow NATO members to increase their defense spending to not just agreed levels, but to also increase that. So the new number that's being talked about is 5%, with the actual direct defense spending accounting for 3.5%, and then sort of an allowance for 1.5% on sort of cybersecurity and infrastructure related spending. So we're seeing the US increasingly become less tolerant of everybody else sheltering under their security umbrella and them having to spend an immense amount. And they likely would continue to do so with or without the other NATO members. And defense stocks naturally benefiting off the back of that. It will be key to see how that ramp up and if that ramp up takes place, because specifically in Germany's case, they're all saying the right stuff, that they're on board with this and willing to increase that defense spending. And in the short term, arguably, it would be relatively easy for Germany to do so through increased debt, which we know that they've made some exemptions in their budget to allow for increased debt measures for defense spending. But in the longer term, there's going to have to be some budgetary negotiations taking place, because they can't fund the increased defense spending purely from debt, at least not in the long term. So, you know, there's going to have to be some areas in the budget that are going to have to take some cuts in order to enable this increased budget on the
And I can imagine that could possibly be difficult, considering where they are politically and, you know, with the coalition.
We know that, it's been well covered, like France, Germany, there's been lots of arguments and negotiations going on there about the budget. So it's a highly contentious area, and we're seeing this pressure. So it'll be interesting to watch how that unfolds in the medium term. I think in the short term, likely, they need to try and appease Trump. So they're all saying that they will increase that defense spending. How they're going to go about financing that will be the key in the longer term. But I think in general, we've seen that with a lot of the European, like Rheinmetall is a good example, trading at very high levels off the back of investors taking the view that, well, we're going to see increased revenues for these businesses because they're the established European defense contractors. I think one other thing to note in the European defense space is the lack of standardization. So, we have all these disparate defense companies, and there's a lack of standardization in terms of equipment and arms across the different EU members. So I think that's something that the EU themselves are going to have to look at going forward. Because they need to present a unified front, to scale up manufacturing, and then, German tanks don't work with French, artillery systems. There has to be some look at that side of the equation as well.
All right, let's look at what's come out from the Fed chair making commentary yesterday, and of course really emphasizing what we know. The central bank says it'll commit to keeping inflation in check as they assess the impact of tariffs on inflation. And as I mentioned, no surprise there, right? We are still seeing the same kind of rhetoric from Fed Chair Jerome Powell, and this despite mounting pressures from President Trump.
Certainly, and I mean, we talk about the word uncertainty. You mentioned it earlier, and we look at some of these metrics in at least company earnings, how the frequency with which words are mentioned. So, AI was a big one. You look at the trend and how much that's getting mentioned. Uncertainty is sort of the flavor of the month or the year in terms of how often the word's being utilized, and no surprise to see the Fed. I think that sums up their position pretty well. So we've talked about it before, but they're still in this difficult situation where, inflation's not quite behaving how they'd like it to, and we're seeing a slight weakening on sort of the labor front. So how do you balance those two? And I think that they've taken the default posture of we're going to sit on our hands and wait to see what the data looks like. Do we see a weakening on the growth front or the labor market, or do we see inflation start to cooperate? And they keep saying that they want to see at least the initial start of the impact of tariffs. Now, it's difficult to say to read that impact because tariffs are on again, off again, then they're reduced, and then we know that the deadline's coming up again next month. So that's a tricky one to base their decisions on because the impact of tariffs are not yet clear. And the biggest challenge I think they face is that any interest rate moves have a significant lag in terms of their actual impact on the economy. So it's a risk of, and you're seeing some of the Fed members starting to mention that, at least the ones in favor of a cut, are starting to talk about the concerns around by the time that we're seeing these impacts in the data, is it now too late and that we've sort of missed the boat for rate cuts? So a tricky position.
Really tough balancing act, hey? And I can imagine, central bankers across the world are also watching the Fed to see what they do, not to follow them, but just to see the trajectory of how that inflation filters through, or rather the impact from tariffs into inflation and how that filters through into the economy. Let's take a look at some company news. FedEx out with numbers overnight, and while they beat estimates in the fourth quarter, it does seem like investors are concerned about their outlook for the year.
This is another one of those great examples where sometimes the market surprises you, because you look at the headline and it's, they beat on revenue and they beat on earnings, and then the shares, when I last looked, was down around 5% pre-market, as you mentioned in that earlier segment. So it's not always a case of how good are the current results. The market is always looking forward. And I mean, the 2 points to mention there was, so the forward guidance was somewhat disappointing, which is largely why we're seeing that share price move. But they also, and you noted it in that short segment earlier, that they declined to give guidance for the financial year going ahead. And I think that speaks to uncertainty again. And I haven't looked at that earnings investor call, but I'm sure that they mentioned uncertainty or some similar words in that call, and likely as a reason not to give that guidance, because the companies aren't certain on what the future looks like because tariffs are up and down. I think the what's good in those earnings that I saw from FedEx is they managed to cut $4 billion of cost, which is a significant number for a business of their size, and they talked about cutting another $1 billion going forward. So I think that was quite pleasing to see. Obviously, the headline number was reasonable. And I think a reasonable set of results out of FedEx. Obviously, tariffs are kind of a key point for FedEx, right? They're in the business of moving goods. One thing that is quite interesting is that their revenues are still quite US concentrated. So we're talking 60-70% of their revenues are primarily exposed to the US. And that's why it was interesting that they mentioned the impact of the US calls it the closing of the de minimis loophole, which was, just to give some context, is a minimum threshold under which packages didn't have to pay certain tariffs or import duties, etc. And we largely saw the likes of Temu and Shein profiting off the back of that. That's now largely been shut down. And interesting to note that FedEx has actually noted that that has had a specific impact on the business. Granted, it's not massive. I believe it was talking around $100 million. But for a business of their size, it's relatively speaking a small percentage. So I think that they are closely watching import volumes because they need goods to be moving, right? And FedEx as well as UPS are often regarded as good bellwethers for the entire economy because they deal with so many different types of businesses. And that'll be an interesting one to keep an eye on. But again, with tariffs being on and off again, it's difficult to gauge where we're going, at least in the short term.
It's really been a tough 5-6 years for many corporates. I mean, from COVID to really tight monetary policy, and now we have the tariffs in the picture, and we still have those geopolitical tensions still playing out across the globe. And with that being said, right, with the uncertainty still being the name of the game, where are you then seeing opportunity? Where are you hiding your money at this point?
So I think following on from the point you just mentioned, there's always challenges, right? And I think I mentioned it before, if you look at a summary of headlines year to date so far, you would think that the markets are having a terrible time. But when we look at it, I mean, earlier this morning, I mean, the NASDAQ, I believe, closed at an all-time high. The S&P 500 very close to an all-time high again. So you could be forgiven for reading the headlines and thinking that markets are doing terribly. And what we like to see is that, and where I'm going with this, is that there are always challenges. Every day is going to present a new challenge. Is it tariffs today? Is it interest rates yesterday? And we like to see company management teams that can deal with those challenges and are constantly dynamic and applying themselves to solve problems. And because there will always be, and there will be new challenges tomorrow, whether it's oil or whatever it might be. So there's a number of companies, but we look at from a management perspective, how does management handle these challenges that are thrown their way? And a company like FedEx, where they're managing their costs, you're doing stuff that's within your control. I think that's key, is what is the company doing that they can control? Because they can't control what the tariff implications are going to be. They have no idea where oil's going. So what levers are they pulling with inside their business to constantly grow and address the challenges that are presented every day?
So FedEx one to look out for?
I think FedEx is one to look out for. It's down around, I think it's over 10% year to date. So there's potentially a bit of value on offer there. But it's a very difficult call to jump into, considering we talk about how much tariffs are on and off again and the impact that could have on a business like FedEx or UPS.
All right, let's leave it there. Thanks so much for your time and joining us in studio this afternoon. That was Jordan Toy from Legacy Family Wealth.